The person with $800,000 in a traditional 401k and the person with $400,000 in a Roth account are not in the same retirement. They are playing two completely different games with completely different rules and two completely different tax bills. The $400,000 person wins not because of what happens when they die, not because the market treated them better, but because of what happens between age 62 and age 75. 3 government systems collide during those 13 years in a way that drains the $800,000 account faster than any correction ever could. And the person with half the money, structured the right way, keeps more of every dollar they spend. Here's the first data point, and I want you to sit with it. A 60-year-old in 2026 pays $515 a month for a benchmark silver health insurance plan on the ACA marketplace. The same 60-year-old, same state, same plan, same coverage, earning $64,000 per year instead of $62,000, pays $1,244 a month. That is the same insurance. The difference is $2,000 in annual income, $2,000 extra dollars in $729 extra dollars out every single month, $8,748 per year in additional premiums. The effective marginal tax rate on that extra $2,000 is 437%. Not 22, not 32. 437%. That is not a typo. That is the ACA Subsidy Cliff. And it came back with full force on January 1st of this year after a 4-year hiatus. Most retirement advice stops at save more. This video is about what that saving actually costs when you try to use it. Here's the thesis. The balance on your retirement account statement is not your retirement number. It is a gross number, the way a salary is quoted before taxes. The real question is, what survives the trip from your account to your wallet? And the answer is almost entirely determined by 3 things. The type of account the money is sitting in, what other income you report when you pull it out, and how 4 separate government systems interact the moment you do. I'm going to walk you through every one of those systems. The ACA Subsidy Cliff that came back in January of this year, the required minimum distribution time bomb that detonates at 73, whether you want the money or not, the Social Security taxation formula that has not been updated since 1993, and the IRMAA Medicare Surcharge, which most people discover when a letter from Social Security shows up announcing their monthly premiums just quadrupled based on income from 2 years ago. Each one of these, taken alone, is annoying. Together, they can erase the financial advantage of having twice as much money. I want you to think about the sticker price on a car. You walk onto the lot, the number on the windshield says $40,000. By the time the dealership adds the destination charge, the documentation fee, the taxes, the title, the registration, and the extended warranty the finance guy assures you is absolutely necessary, you're writing a check for $46,000. The $800,000 traditional 401k is the sticker price, not the out-the-door number. Every time you open your brokerage statement and see that balance, you're looking at a number the IRS has a lien on. A lien they will collect, not if, when. The $400,000 Roth account, different sticker, closer to the out-the-door number. The tax has largely been paid. What you see is closer to what you get. I'll come back to this metaphor every time a new layer of the system reveals itself, because the car lot comparison gets more accurate and more absurd as we go deeper. There is a foundational problem with how the retirement industry handles all of this. The calculators, the brochures, the retirement readiness projections, the 4% rule, almost everything operates at the sticker price. They model how much money is in the account and when it runs to zero. They rarely model the interaction between your withdrawal sequence, your pre-Medicare health insurance costs, your Social Security taxation rate, and your Medicare premium surcharges, all in the same year. Because that is 4 moving variables, and 4 moving variables don't fit on a pie chart. I spent over a decade running my own business, surrounded by accountants and tax attorneys, watching exactly how money flows through these systems. And the thing that surprised me most wasn't the complexity. It was how cleanly avoidable most of these problems are once you know where the cliffs are. In a few minutes, I'm going to show you what happens at age 73 when the government turns your retirement account into a mandatory income machine, whether you wanted the withdrawal or not. But first, let me show you why the decade before that is, financially, one of the most dangerous stretches in American retirement, and why it specifically punishes the people who save the most in the wrong place. You retire at 62. Medicare doesn't start until 65. That is 3 years at minimum, potentially longer if you retire early, where you are buying health insurance on the open market. Before January 1st of 2026, this gap was painful but manageable. The American Rescue Plan and the Inflation Reduction Act had expanded ACA subsidies to the point where premiums were capped at 8.5% of household income for everyone, regardless of how much you earned. No income ceiling. The cliff was gone. That expired on December 31st, 2025. Congress failed to extend it. The cliff is back. Here's how it works. ACA subsidies in 2026 cut off completely at 400% of the federal poverty level. For a single person, that threshold is $62,600. Earn $1 above that, and you lose every dollar of subsidy. Not a phase out, not a taper. Everything gone instantly. The KFF analysis of this specific scenario puts exact dollar figures on it. A 60-year-old earning $62,000 pays $515 a month for a benchmark silver plan. The same 60-year-old, same age, same plan, earning $64,000 pays $1,244 per month. The monthly difference, $729. Annualized, $8,748 because of $2,000 in extra income. That is the mechanism. Not a tax rate, not a bracket, a cliff. $1 over the threshold, and you're paying the full unsubsidized premium. For a 60-year-old, in many markets, that premium runs over $14,000 per year. Now here is exactly where the person with $800,000 in a traditional 401k gets hit. To pay for their retirement, they have to pull money out of their IRA. Every single dollar they withdraw is taxable income. It gets added to their adjusted gross income and reported to the IRS. If they need $60,000 a year to cover their bills, food, housing, travel, all of it, the math forces them to gross up that withdrawal. After the standard deduction of roughly $15,000, the taxable portion of a $75,000 withdrawal gets taxed at 10, 12, and 22%, depending on the chunk. They net close to $60,000 after federal tax. Fine. Except their gross reported income is $75,000. The ACA cliff for a single person is $62,600. They are $12,000 over the cliff before they pay a single utility bill. Health insurance, $14,928 per year, gone before groceries. The $400,000 Roth account holder, she pulls $60,000 from her Roth. Roth distributions are not counted as income for ACA subsidy calculations. Her reportable income for healthcare purposes might be $10,000 from a small dividend account and some interest. She qualifies for a significant subsidy. Her premium might be under $300 a month, under $3,600 per year. Annual healthcare savings, $11,000 to $14,000. Not from having more money, from having the money in the right kind of account. For a married couple, the math is even more dramatic. The ACA cliff for a two-person household in 2026 is $84,600. A couple that needs $70,000 to live on, pulling from a traditional 401k where the gross distribution must be around $88,000 to net $70,000 after taxes, is over the cliff. Their unsubsidized premium in many states, over $22,000 per year. One report cited premiums spiking by more than $30,000 annually for some couples in high premium areas. Once they crossed that threshold, $30,000, for health insurance, because their gross withdrawal was a few thousand over the line. Think about what that does to the math. The person with $800,000 in a traditional account might spend $75,000 to $90,000 per year in gross withdrawals just to net $60,000 or $70,000 after taxes and premiums. The Roth person with $400,000 spends dramatically less from their account to achieve the same lifestyle because their health insurance is subsidized and their withdrawals are invisible to the system. This is the sticker price versus the out-the-door price. Both portfolios said enough to retire. The receipt told a different story. I talked to my advisor, you're saying. He ran the numbers. He ran the balance number. Did he run the ACA Cliff number? Did he put your income, your subsidy eligibility, and your premium cost in the same spreadsheet? Most don't, because most retirement modeling tools are built to project balances, not to model income-dependent benefit interactions. The tools were designed for accumulation. You've been accumulating, now you're decumulating. And decumulation has a completely different physics. By the way, hit subscribe if you like the content, otherwise YouTube's algorithm may never show you my videos again. The ACA cliff is painful, but it ends at 65 when Medicare begins. What comes next does not end. And it starts with a government letter you receive in your early 70s that is politely informing you that you must take money out of your own account. Whether you need it, whether the market is up, whether you want it, does not matter. At age 73, the IRS requires you to begin taking required minimum distributions from every traditional IRA and 401k you own. This is not optional. Under Secure 2.0, the penalty for not taking your full required distribution is 25% of the amount not withdrawn. The government has been patient long enough. It deferred these taxes for 30 or 40 years. Now it wants its share. The calculation is simple. Take your December 31st account balance and divide it by a life expectancy factor the IRS publishes by age. At 73, that factor is 26.5. At 75, it drops to 24.6. The older you get, the smaller the divisor, the larger the forced distribution. Here's what this means for the $800,000 account holder. They retired at 62. If that money grows at 6% per year for 11 years, completely reasonable for a diversified equity-heavy portfolio, it becomes approximately $1.5 million by the time they turn 73. 1.5 million divided by 26.5. That's $56,600, mandatory, taxable as ordinary income every year. Add Social Security. The average retired worker receives about $24,800 in annual benefits in 2026 after the 2.8% cost of living adjustment. So this person now has approximately $81,000 flowing in $57,000 from the IRA, $24,000 from Social Security, almost none of which they chose to take in this specific amount or at this specific time. Now here's the tax cascade. And this is where the sticker price metaphor breaks down in the most expensive possible way. The Social Security benefit taxation formula works like this. You calculate your combined income, which is your adjusted gross income, plus any tax-exempt interest, plus 50% of your Social Security benefit. If that combined income, as a married couple filing jointly, exceeds $44,000, up to 85% of your Social Security benefit becomes taxable. Not 30%, not 50%, 85%. And that threshold, the $44,000 threshold for couples, the $34,000 for single filers, has not moved since 1993. That year, the average Social Security benefit was less than $8,000 annually. Today, it is nearly $25,000. The thresholds were calibrated to tax the wealthy in 1993. They now capture the middle class automatically every year, as COLA adjustments push benefits higher against thresholds that never move. Our person with 1.5 million in forced distributions is at 81,000 in combined income, far over the 44,000 threshold. 85% of their Social Security is now taxable income. That's another $21,000 added to their tax base. Their effective taxable income after standard deductions and the senior bonus deduction, now available in 2026, still puts them firmly in the 22% bracket, with a tax bill approaching $15,000 per year on money they were effectively forced to take. And then Medicare takes its swing. IRMA, the income-related monthly adjustment amount, is a Medicare surcharge added to your Part B and Part D premiums when your income exceeds certain thresholds. In 2026, It kicks in at $109,000 for a single filer, $218,000 for a married couple. Standard Part B premium, $202.90 per month. Cross the Tier 1 IRMA threshold as a couple, and that jumps to $284.10 per person per month. At the highest income tiers, the premium reaches $689.90 per month, more than 3 times the base rate. Here's the part that genuinely catches people off guard. IRMA is calculated using your income from 2 years ago. Your 2026 Medicare premium is determined by your 2024 tax return. A large Roth conversion you did in 2024, or a one-time capital gain from selling property, or a year you had unusually high income for any reason, follows you into your Medicare bill 2 years later, even if your income has since dropped to zero. Most people don't know this until the letter from Social Security arrives. And $1 over any IRMA bracket threshold triggers the full surcharge for the entire year. For a couple, crossing from the standard rate into Tier 1 costs approximately $2,297 more per year for each of them if both are on Medicare. That is a potential premium spike of nearly $4,600 per year because of one extra dollar of income. This is the cascade the $800,000 person walks into. At 73, forced distributions trigger income tax. The income tax triggers Social Security taxation at 85%. The combined income might push Medicare premiums into a higher IRMA bracket, which is based on income from 2 years ago anyway. So you're managing an echo. 3 simultaneous tax events firing from one source. The traditional IRA. The Roth account holder, no required minimum distributions, ever during their lifetime. They take what they need, when they need it, and the amount that keeps their total income in the most favorable bracket. The cascade has no trigger because the gun has no ammunition. Here is a number that should make this concrete. Over a 20-year retirement, the cumulative difference in taxes, health insurance premiums, and Medicare surcharges between a person drawing primarily from a traditional account and a person drawing primarily from a Roth with the same lifestyle can exceed $200,000 on identical spending, just different receipts. That's the exit cost on the sticker price retirement. The lot said $800,000. The out-the-door number was something else entirely. Here's the part that never makes it into a standard retirement calculator. Knowing these numbers is one thing. Building a withdrawal strategy around them before you retire is a different discipline entirely. Most advisors who charge 1% of your assets per year to manage your portfolio will explain 1 or 2 of these mechanics, rarely all of them together, and almost never with a specific income plan showing you which account to draw from in which year to minimize their interaction. I built a digital book called The Exit Code, 8 chapters of actual retirement data, 50 years of it, distilled into a mathematical framework for figuring out specifically when the numbers say you are done, not when you feel ready, when the math confirms it. 2 pieces of it connect directly to what we've been talking about. The dynamic withdrawal method, which replaces the flat 4% rule with a system that adjusts based on your tax bracket, your income-dependent benefit eligibility, and your account composition. Because a static 4% on a traditional account that ignores the ACA cliff and the RMD cascade is not a withdrawal plan, it is a wish. And the Social Security bridge strategy, how to delay claiming Social Security to age 70 to capture the guaranteed 8% per year delayed retirement credit without running your accounts dry waiting for it. You can get the whole thing through the link in the description for less than what you would spend on a dinner out. Every year you wait to build this system, the gap compounds against you, not dramatically, but relentlessly. Stay with me here, because the next part shifts the fundamental question. We have been asking, how much did you save? The question that actually determines your retirement outcome is something different. Where did you save it, and in what order do you spend it? There is a number almost nobody optimizes for. It's not your total balance. It's your effective marginal tax rate on each dollar you spend in retirement. Because when you have 4 potential income sources, Roth IRA, traditional IRA, taxable brokerage, and Social Security, and you need $60,000 per year to live on, you have choices. And the order in which you use those sources determines whether you trigger the cascade or avoid it entirely. Here's the mechanics of how the smart version looks. You pull $25,000 from your Roth, zero taxable income generated. You pull $15,000 from a taxable brokerage account, holding long-term positions. If your total income is low enough, below approximately $48,000 for a single filer in 2026, those long-term capital gains are taxed at 0%. Zero. Not 15, not 20, zero. You draw the remaining $20,000 from cash reserves built during your working years. Your total reported income for the year, $15,000 from the brokerage. You are nowhere near the ACA cliff. You're nowhere near the Social Security taxation threshold. You are not generating the trigger. Now, contrast this with the person who takes $60,000 from a traditional 401k. Same amount of spending. The taxable income is radically different. The ACA premium is different. The effective tax rate is different. The Social Security taxation status is different. The spending power is the same. The tax receipt is not. The three-bucket retirement taxable, tax-deferred, and tax-free is not a new concept. But most of the people who talk about it focus on the accumulation side, contribute to all three. Diversify your tax exposure. What receives far less attention is the decumulation sequence. Which bucket you draw from, in which order, and how you manage the interaction points where one bucket's withdrawal affects the tax rate on another bucket's income. There's a parable here. A farmer who pays for a seed at planting time versus a farmer who defers payment until harvest. The deferred payment farmer seems richer in the short term. He has more cash on hand during the growing season. But at harvest, when prices are uncertain, when the government sets the terms, when the rules have shifted, the bill comes due in the least convenient way possible. You built the yield. You do not get to set the price on the day you collect. The IRS does. The traditional IRA and 401k are deferred payment retirement vehicles. You didn't eliminate the tax. You negotiated a payment plan, and the payment is due at a time and in an amount that the government, not you, controls. This brings me to the Social Security delay angle, which is where the Roth account holder can build a structural income advantage that compounds for decades. Delaying Social Security from your full retirement age to 70 adds 8% per year to your monthly benefit. If your full retirement age is 67, waiting from 67 to 70 increases your benefit by 24%. Guaranteed. Indexed to inflation for the rest of your life. And for someone born in 1960 or later, claiming at 62 instead of waiting to 70 means permanently locking in 70% of your full benefit instead of 124%. That gap, played out over a retirement that averages into the mid-80s for someone reaching 65 today, is substantial. The trap is this. If you need income between 62 and 70, and everything you have is in a traditional IRA, every dollar you pull for living expenses generates taxable income, which puts you on the wrong side of the ACA cliff before 65, potentially triggers Social Security taxation when benefits finally begin and can set your IRMA baseline for Medicare. The very strategy that would maximize your monthly Social Security check waiting to 70 is working against you. Every year, you're living on traditional IRA withdrawals in the meantime. The Roth account holder can bridge those years, pulling from Roth, zero income generated, zero ACA cliff risk, zero Social Security taxation trigger. They arrive at 70 with a benefit that is potentially 77% larger than if they had claimed at 62 and they did not pay the tax penalty to get there. Now here is the part most people think requires perfect hindsight, because everything I've described sounds like a problem you had to solve 20 years ago when you were deciding whether to contribute pre-tax or Roth. But that's not entirely true. The Roth conversion window is the period between retirement and age 73 when required minimum distributions begin. Retire at 63, RMDs at 73. That is potentially a 10-year window during which your income may be the lowest it will be for the rest of your life. No salary, no Social Security yet if you're delaying, no mandatory IRA distributions yet. In many cases, your taxable income sits close to zero. That is not a problem. That is the most valuable tax planning window of your life, and most people do nothing with it. Roth conversions during this period move money from a traditional IRA into a Roth. You pay the tax now at whatever low rate you're in during these gap years, and you permanently eliminate future taxes on that money. No annual limit on the amount converted. No income restriction, unlike Roth contributions themselves. For a married couple with no other income in 2026, the conversion capacity inside the 12% bracket alone is approximately $133,000. At 12%, you're paying roughly $13,000 to $15,000 in tax to convert $133,000. That money then grows tax-free for potentially 20 or 30 years. When you eventually need it, you pull it at 0% federal income tax. And no RMD is ever forced from that Roth account during your lifetime. Multiply that over a 7 or 8 year conversion window, staying disciplined about bracket limits and the IRMAA 2-year look back, and you have meaningfully reduced the traditional account balance that will generate forced RMDs at 73, smaller RMDs, lower combined income, 85%, Social Security taxation becomes 50% or 0. IRMA, Tier 1, never triggers. The cascade never fires. The optimal Roth conversion window, according to tax planning professionals, often runs from age 62 or 63 through age 72, specifically the years before both RMDs and full Social Security kick in simultaneously. Those are often the lowest income years of a retiree's life, which makes them, counterintuitively, the highest leveraged tax planning years of a retiree's life. But I'm already 70, you're thinking. Even after RMDs begin, qualified charitable distributions let you send up to $111,000 directly from your IRA to charity in 2026, which counts toward your required distribution but is excluded from your adjusted gross income. If you are charitably inclined and have RMDs pushing you into unwanted income, this is one of the cleanest tools available. My advisor says max your 401k and everything will be fine. And then you hit 62 and the ACA Cliff sends your health insurance premium past $14,000 a year. Amused disappointment. That's the only appropriate response. Let me put real numbers on this with two hypothetical retirees. Call them Doug and Maria. Doug is 62. He retires with $800,000. All of it in a traditional 401k. No Roth, no taxable brokerage. His whole life, conventional wisdom said max the pre-tax account. He did. He needs $60,000 per year to live his life reasonable by any measure. To net $60,000 after taxes, Doug must withdraw approximately $75,000. After the standard deduction, his taxable income runs into the 22% bracket on the upper portion. He nets close to $60,000. But his gross income reported to the IRS and to the ACA marketplace is $75,000, well above the $62,600 single-person cliff. His health insurance, $1,244 a month, $14,928 per year. His account goes down by $75,000 in year 1, while he spends $60,000. Maria is 62. She retires with $400,000, half Doug's balance. But she built 3 buckets. $100,000 in a taxable brokerage, holding long-term appreciated positions. $200,000 in a Roth IRA, $100,000. In a traditional IRA, she's been doing modest Roth conversions from since she was 58. She also needs $60,000 per year. Maria pulls $25,000 from her Roth. Tax impact, 0. She pulls $20,000 from her taxable brokerage, all long-term positions. Her total income is low enough that those gains are taxed at 0% federally. She pulls $15,000 from a savings account she built in her last 2 working years as a buffer. Her total reported income for ACA purposes, $20,000. Massive subsidy. Her health insurance premium under $200 a month, under $2,400 per year. Year 1, Doug spends $75,000 gross to net $60,000 in lifestyle purchasing power, plus pays $14,928 in premiums. He's effectively burning $89,000 from the account to live on $60,000. Maria spends $40,000, total $60,000 in purchasing power, but with subsidized insurance reducing the effective health costs, and her account goes down by $40,000, that's a $49,000 annual difference in account drawdown between two people with the same lifestyle, not from investment returns, not from market timing, from account composition and healthcare subsidy eligibility. Now we get to 73. Doug's account, having grown at 6% per year for 11 years from $800,000, is approximately $1.5 million. His RMD, that first year, $56,600. Combined with Social Security at roughly $24,000, his total income is $80,000. Far above the $44,000 combined income threshold, 85% of his Social Security becomes taxable. His total taxable income, after deductions, creates a federal tax bill in the $15,000 to $18,000 range on money he didn't choose to take. His Medicare premium may be near or above the IRMAA Tier 1 threshold, depending on that year's income. Maria arrives at 73 with a Roth account that may have grown from $200,000 to $350,000 decades of tax-free compounding. Her traditional IRA, after years of modest Roth conversions during the gap years, might be $150,000 her RMD, roughly $5,600. Combined with Social Security, she delayed to 70, collecting about 30% more per month than if she had started at 62. Her total combined income for Social Security taxation is well under the threshold for the 85% rate to kick in. Her Medicare premiums remain at the standard rate. Over 15 years of retirement, the cumulative difference in taxes paid, premiums paid, and Medicare surcharges between Doug and Maria runs well past $200,000, maybe considerably more, depending on state taxes and specific circumstances. Doug had more sticker price. Maria had more out the door. And here's what ties all of this back to the subplot that has been running through this video. The retirement industry, the advisors, the calculators, the glossy projections built their entire analytical framework around accumulation. How much are you putting in? How fast is it growing? When does the account hit zero? These are the questions the tools answer. They are not the wrong questions, they're just incomplete ones. The questions that actually determine whether the sticker price retirement delivers anything close to the out-the-door retirement are different. What is my effective tax rate on each dollar I spend? What does my income look like to the ACA system before 65? What does my combined income look like to the Social Security taxation formula? What does my MAGI look like to Medicare's look-back system 2 years from now? What will my forced distributions force my income to be at 73? These are income architecture questions, not balance questions. And income architecture is largely invisible to the tools that most advisors use and most savers consult. You cannot fix this at retirement. You build the solution during the accumulation years, or you use the gap years between retirement and 73 to convert aggressively, but you cannot ignore it until the check arrives and then negotiate. 3 specific calibrated takeaways from this video. 1, measure your retirement readiness in after-tax, after-subsidy, after-healthcare dollars, not gross account balance. The sticker price on the account is not the out-the-door price you'll pay to use it. Model your gross income at 62, 65, 73, and 75. Those are the 4 moments where the tax architecture changes dramatically and where the difference between the right structure and the wrong structure is largest. 2, if you are currently in the gap between retirement and age 73, run a Roth conversion analysis before December 31st of this year, not as an abstract exercise. Actually model your bracket. The 12% bracket for a married couple filing jointly in 2026 extends to roughly $94,300 of taxable income. If your income this year is well below that, you have room to convert at a rate far lower than you will eventually be forced to withdraw at during RMDs. The tax bill you pay now on a conversion might be $3,000 or $4,000. The tax bill the IRS imposes at 73 on the same money could be double that, with Social Security, taxation, and IRMA layered on top. 3, treat every income threshold in retirement as a cliff, not a gradient. The ACA Subsidy Cliff at $62,600 for a single filer, the Social Security taxation threshold at $34,000, the IRMA surcharge at $109,000. None of these phase out gracefully. They are vertical drops. One extra dollar costs you hundreds or thousands, or $8,748 in annual premiums. Plan your income so you land below these thresholds intentionally each year, by design, not by hope. Lazy investing built more fortune than crypto memes. And if your financial advisor hasn't shown you a spreadsheet with your ACA subsidy eligibility mapped against your withdrawal sequence, your projected Social Security combined income at 73, and your estimated IRMA exposure 2 years into Medicare, go ask for it at your next meeting. The answer they give you will tell you exactly what kind of advice you've been paying.